Look, imagine your favorite, seemingly invincible sports team just absolutely dominating the season, right? And then, out of nowhere, on a random Tuesday, they just get dismantled by an underdog. That shock. That is exactly what Palantir investors woke up to on April 9th, 2026. We're doing a deep dive today into a massive repricing event.
Yeah.
Palantir, ticker PLTR, dropped 7.3% in a single session.
Yeah, I mean, that's $23 billion in market value just vaporized between your morning coffee and the afternoon commute. And it forces us to ask the hard question, is this a structural flaw in Palantir's model, or is this just an emotional market mispricing a generational asset? Because when a stock is priced for absolute perfection, any tiny deviation triggers a violent repricing.
Exactly. And we've got the data to figure this out today. We're pulling from 24/7 Wall Street, Markets.com, The Street, and Palantir's own Q4 2025 transcripts. The core thesis for you today is simple. PLTR's price dropped. Is it time to run, or is it time to buy? Let's start with the immediate catalyst, because a $23 billion haircut doesn't happen without a spark.
Right. And in this case, the spark was a single, quickly deleted post on X from Michael Burry, the big short guy. He posted that the AI startup Anthropic is, quote, eating Palantir's lunch. And look, he anchored that with some highly aggressive data.
Yeah, that ARR comparison he made was brutal.
It was. He pointed out that Anthropic's annual recurring revenue, their ARR, surged from $9 billion at the end of 2025 to $30 billion just a few months later. And Burry contrasted that vertical trajectory with Palantir, noting it took them, 2 full decades of grinding enterprise sales to hit roughly $5 billion in ARR.
Which is jarring.
Yeah.
And he backed that up with corporate spending data from Ramp. This tracks where businesses are actually swiping their cards. The data shows Anthropic capturing 73% of all new enterprise AI outlays. 73%. Nearly 1 in 4 Ramp customers are paying Anthropic now.
Which is up from 1 in 25 just a year ago. And the driver here is Anthropic's new Claude managed agents. To understand the threat, you have to look at the mechanics. A managed agent is just a ready-to-deploy digital worker. Anthropic is promising consumer-grade simplicity at enterprise scale.
Right, and they're doing it cheap.
Exactly. They are charging standard API rates plus just 8 cents per session hour. For context, an API is just a digital plug. It lets a company's existing software plug right into Anthropic's models. They claim these agents get internal teams to full production 10 times faster than a custom build.
Look, I get the speed argument, but I'm looking at these numbers, and comparing an 8-cent an hour API to Palantir's operating system feels like a massive category error. I mean, is this a fair fight? It's like comparing a microwave to a Michelin star kitchen. One heats up a burrito in 2 minutes, but the other requires, specialized chefs and hours of prep.
The Michelin star analogy is perfect because it highlights the difference in capital expenditure. The problem for Palantir is that corporate America is starved for immediate margins right now. They want the microwave. They want plug-and-play AI that delivers immediate cost savings without an army of forward-deployed engineers.
Which makes sense for basic tasks.
Right. Anthropic leases raw compute and scales profitably with off-the-shelf solutions. Palantir involves heavy, customized integration. So to a commercial client looking to automate data entry by the end of the quarter, Palantir looks bulky.
But a deleted tweet about a competitor's speed doesn't crater a large cap stock by $23 billion. The powder keg had to be primed. And if we look at the Markets.com analysis regarding the macro environment on April 9th, the real context snaps into focus.
The macro is the real fuel here. The morning of the drop, the March 2026 CPI print hit. Inflation was sticky. It rose 0.9% month over month, pushing the annualized rate to 3.3%. That specific data point effectively assassinated any institutional hopes for Fed rate cuts in 2026. The era of free capital is closed.
That CPI print acts as a gravity well for tech. It's like the 1800s railroad boom. Investors throw endless cash at the companies laying the tracks, but eventually capital gets expensive, the hype fades, and the market demands to see the actual freight receipts. They want bottom-line improvement today.
Analysts are calling this the monetization fracture. We are witnessing a brutal rotation out of pure AI euphoria into a highly skeptical, execution-focused phase. Capital is flowing out of high-multiple software and back into hard infrastructure. Palantir was priced for flawless hypergrowth. I mean, their trailing PE was hovering between 200 and 235 times earnings.
With a forward PE well over 100. And let's break down why that PE is a massive liability when inflation ticks up. A 200 PE means investors pay $200 for every single dollar of profit. You only pay that premium if you believe profits will multiply rapidly.
Right. It's all about discounted future cash flow. When you buy at a 200 PE, you're buying profits 5 or 10 years out. But when inflation stays sticky at 3.3% and rates remain high, the present value of those distant dollars plummets. Why risk capital on a volatile software stock promising profits in 2030 when you can lock in a risk-free yield on short-term bonds today?
High interest rates act like a scythe on tech valuations. And it wasn't just Palantir. Snowflake dropped 9%, Cloudflare dropped 12%. The market is fracturing. So you have a grim macro environment, expensive capital, and cheap AI agents flooding the zone. You'd assume Palantir's core business is deteriorating.
Which is the logical assumption, but it's completely wrong.
Exactly. The report from the street digging into their Q4 2025 audited financials presents a startling contradiction. The numbers tell the story of a company operating at absolute peak efficiency.
Look strictly at the fundamentals. Palantir is a financial juggernaut. Total revenue grew 70% year over year to $1.41 billion. And crucially, their U.S. commercial revenue, the exact sector where Anthropic is supposedly eating their lunch, exploded by 137% to $507 million.
Those top-line numbers are crazy, but the bottom-line profitability is the real signal. They reported GAAP net income of $609 million. This isn't adjusted pro forma nonsense where they hide stock-based comp. This is hard profit, a 43% margin.
Yeah, $777 million in pure cash from operations in one quarter. They have a $7.2 billion cash war chest and zero debt. Zero. A pristine balance sheet in a high-rate environment is a massive structural advantage, and they closed a record $4.26 billion in total contract value.
180 deals over $1 million each. And CEO Alex Karp emphasized their Rule of 40 score, which hit an astonishing 127%. The Rule of 40 adding revenue growth rate to profit margin, if it's over 40%, you're golden. Hitting 127% at a billion-dollar run rate is basically unprecedented.
It's unheard of, and they guided for 61% revenue growth in 2026.
But wait, here's the contrarian edge. Digging into the transcripts, Karp said there was inexplicable growth in revenue, but not inexplicable growth in customers. So if they aren't bringing in a massive wave of new logos, what is driving a 137% spike in commercial revenue?
It's the AIP Bootcamp strategy, artificial intelligence platform. Historically, Palantir's sales cycle was a 6 to 9 month grind of PowerPoint and steak dinners. They killed that model. Now, they physically send engineers into a client's ops center for a multi-day bootcamp, offering the core software for free during the trial.
So instead of pitching the Michelin star kitchen, they just build a functional kitchen in your warehouse and start cooking your own ingredients.
Precisely. The engineering team connects directly to the chaotic, siloed data Excel, Workday, Salesforce. Within 48 hours, they build a secure AI app that solves a specific operational bottleneck. The execs see their own live data being optimized, and the sales cycle just ends right there. The ROI proves itself.
That explains the revenue disconnect. Existing customers are just rapidly expanding utilization. They sign massive contract extensions across new departments. And because Palantir doesn't spend equivalent marketing capital on those secondary contracts, the margins just explode.
Exactly. Their commercial gross margins are stretching to nearly 82% in this AIP era. Corporate clients are buying highly profitable, off-the-shelf modules now, not just the endless custom engineering of the past.
But look, the commercial space is still a knife fight. Palantir has a structural moat, though, that an API startup just cannot replicate. The defense, intelligence, and government sectors. This is where the Anthropic threat thesis completely falls apart.
A Fortune 500 company might risk a cheap chatbot for customer service, but national security is existential. You do not run U.S. military logistics through an 8-cent API. U.S. government revenue grew 66% year over year. The institutional buy-in is staggering.
The Pentagon classified their Maven Smart system as a program of record with a $1.3 billion ceiling. The Army structured a deal allowing up to $10 billion in data integration over 10 years, and they've proven this in live combat environments, like in Ukraine.
They synthesize terabytes of unstructured data satellite feeds, drone telemetry, radio intercepts into a single interface. Commanders identify targets with impossible speed. The geopolitical environment guarantees this funding.
And we have to note the political visibility here. Former President Donald Trump recently praised Palantir's warfighting capabilities regarding Iran. Now, we remain strictly impartial here. We aren't endorsing any politics. But analyzing that purely as a factual market catalyst, it highlights how deeply entrenched Palantir is in the U.S. defense apparatus.
The barrier to entry is insurmountable for a Silicon Valley startup. You need security clearances, audited pipelines, zero-trust architecture under literal artillery fire. An AI company building consumer chatbots cannot just pivot into defense contracting.
And the unit economics back that up. The average government customer generates $10.5 million annually. That is incredibly sticky revenue.
Once an intelligence agency integrates its data ecosystem into Palantir's Gotham platform, the friction to rip it out is astronomical. The switching costs are too high. That multi-billion-dollar revenue stream is a permanent safety net. Pure-play AI API providers do not have that bedrock.
Let's synthesize this for the portfolio. Palantir is the rope in a vicious tug-of-war. On one side, you have the macro gravity. Michael Burry's warning, 3.3% sticky inflation destroying multiples, and the lightning-fast emergence of cheap AI commoditizing the enterprise space.
And pulling in the opposite direction is their audited reality. A financial titan, 70% overall growth, 137% commercial growth, $7.2 billion in cash, zero debt, and an impenetrable government moat.
So the result of the April 9th crash is a brutal valuation reset. Palantir's forward PE actually compressed below 100x for the first time in over a year. While still historically expensive, if they hit that 61% growth guidance, this 7.3% drop might be the exact entry point patient capital's been waiting for.
Here's the real question nobody's asking. If you remember one thing, it's this. Are you buying the ephemeral hype of the newest, fastest language model that will be superseded in 6 months? Or are you buying the deeply entrenched, unglamorous operational infrastructure required to actually make those models useful in the physical world?
That is the ultimate provocative thought for you today. As AI models race to the bottom, becoming completely commoditized, where is the real value? Is it the company building the smartest digital brain, or the company building the digital nervous system? The infrastructure capable of wiring that brain into the messy, high-stakes reality of a hospital, a global supply chain, or a live battlefield.
And through that lens, a $23 billion sell-off might just be the market momentarily confusing the value of the brain with the necessity of the nervous system.
Think back to that sports team. Maybe they didn't lose their edge. Maybe they just played one rough game on a muddy field, but the franchise is stronger than ever. Keep questioning the headlines, interrogate the data, and we will catch you on the next deep dive.